Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over a comment that someone has. It's a really good question. I wanted to cover it, make sure everybody understands, because I do throw a lot of stuff out. I've been investing for probably 18 years, um, and this stuff kind of just comes natural. It just I think about it a lot. This commodity bull market, I'm very much pro commodities, very integrated into tangible assets. And tangible assets are something that I just gravitate to. I mean, when I went through engineering, I started in electrical engineering, but it was an intangible to me, so I didn't like it. So I migrated to manufacturing, mechanical type classes because it's more tangible, and that's just kind of how I've always looked at. I also went through the tail end of the last commodity bull market in the mid 2000s. That's when I graduated college. That's when I started working, started investing money, and I saw some of these companies do crazy things, absolutely crazy things. And that was a liquidity driven event that didn't have the shortages that I think we're going to have going forward. And I was looking at like Ultra Petroleum and Chesapeake Energy back in that day. Aubrey McClendon was the CEO of Chesapeake. It did probably a 50 or 60 bagger. So did Ultra Petroleum. That was like 100 and something, 200, 100, 200, 300, 400 bagger. I don't even know what it was. They went bankrupt here like after the long-term bear market because they were a high-cost producer. But they did absolutely incredible things during that bull market, and I saw it. I saw it like, it was like every day it was like 5, 6%, 5, 6%, 5, 6%. It's like just stacked like for many, many days in a row. And I was completely in disbelief of what I was seeing. So I'm gonna get to the question here. I was just kind of giving my background on what the tangible assets versus intangible things. And I'm gonna make another comment here. I'll just keep diving into this for a second. At a market top, at a market peak, or let's say a civilization peak, right? When everything is plentiful, then people are going to migrate into intangible things. And intangible things like crypto, like a metaverse, like technology type things, you can speculate on all of those things when you have surpluses in commodities, when you have surpluses in energy, when you have surpluses of everything. Because everything in that world is fantastic. It's absolutely great. But if you hit a hard limit to growth somewhere, and what I'm proposing is everywhere, those intangibles will not be valuable. They're going to go, all that money is going to rotate into tangible items or tangible things, because the tangible things control the intangible world. Tangibles are what control everything. That's where all the wealth is. All the wealth is in tangible things. It's in a house that is built that has all the lumber and energy put into it, sunk into it. Think of everything as an energy sunk cost. So the way that I'm viewing everything in this world is, what is the value of that tangible asset to people in this world? Silver, you could have it's the number 2 commodity. The number 1 commodity is oil. Those two things are going to be some of the most, I think, ludicrously priced things if oil becomes more scarce. If natural gas becomes more scarce, if energy becomes more scarce, then you start calculating things differently. We've been in the paradigm that everything is based off of dollars, that high prices cure high prices. Maybe that paradigm is about to get turned upside down. And what do I mean by that? Well, I'm an engineer, and what do? We calculate everything in energy. So now you might be pricing dollars per energy unit. How much is this house worth given how much energy was put in to make it? If energy becomes the pricing factor, not dollars, that energy does, then we may look at the paradigm that people are looking at everything is, well, how much energy did it take to make that? How much energy did you put in to do this? How much energy does it take to do X, Y, Z, or whatnot? Then everybody's going to be looking at efficiency. How can you get the least amount of energy for whatever end result that you want? Maybe we start pricing things in an energy content basis. I can tell you this: how much is oil? What's the true value of a barrel of oil? Well, if you were to tell me Um, what's the value of a big front loader type? I don't know. We'll call it like a Bobcat, right? You got a Bobcat. It's got a little loader in the front, and you can take a whole bunch of dirt and move it very quickly. What's that value versus doing it by hand, literally with shovels? I would say that the value of that is far higher than where we were in a plentiful energy society. And I don't know if this energy is going to get more scarce. I don't have all the answers, guys. I'm just making my point that the way that we look at things, the paradigm and the pricing may be completely mispriced, given where we came from versus where we're going to. Energy might become far more scarce. And the reason I'm stuck on energy right now is because I just did some energy clips and I was reading some quotes on everything, and I'm just trying to test the boundaries, test the thought paradigm that people have. It doesn't mean what I'm saying is going to be 100% true, so please don't take it as at face value. I'm just discussing different ways to look at things. And as an investor, what I'm doing is I'm looking at the chess. I'm looking at the chess game. I'm looking at the table, and I'm looking at potential moves and the ramifications and tertiary effects of those moves. So when you look at something, you make a decision. Usually, when you make a decision, you have an outcome. It's I go right, I have an outcome. I go left, I have an outcome. So what people don't realize. So let's say a government says, "Hey, I created this position." Well, that position destroyed something else over here because they don't create value. They take it they steal it through taxes. Then they say, "Oh, I created this position. Everybody, look, I created this position." I look in my head, and this is very Peter Schiff-ish, which he's right on this. It's like, what did you destroy in order to create this position? You had to destroy something in the real economy, which would have added more value to people. So it's really just a big destruction. So when you look at like energy, if energy goes short, there's ramifications that like basically knock over the domino that starts this chain of reactions. So we could see food shortages, we could see fertilizer shortages, we could see all sorts of things with high energy prices in natural gas, and that's exactly what we're seeing. And then you're going to see all these tertiary effects blow out, and maybe we have like a boom bust cycle where it booms up, busts again, booms up, busts again, and we can't grow because we're energy constrained. I don't know. But getting to the question, I was kind of going off topic here. So you contradict yourself in a sense because you're saying that the cycle just started and it's going to last 10, 20, 30 years. But then you're saying you're looking for companies that are still down. So which one is it? Based on your logic, everything is down and everything is cheap right now as far as commodities go. Well, commodities are becoming more expensive. We can see that the ratios are compressing. We just saw that oil broke out of its oil to gold ratio on the lower line. It's getting more expensive. It's now getting close to the average of the cost. But some of the companies don't move as much against oil. Some take off in the beginning of the cycle. Some have lagged, depending if they're high cost producers or not. The energy service companies have lagged. So usually the exploration and production companies go up very similarly to oil. And then the energy companies lag a little bit because they get paid after. Their services aren't needed in the beginning because we're in a very constrained state of their spending of those companies. So what I'm doing is I'm going around looking for laggards in the oil exploration companies, maybe high cost producers, ones that haven't moved, stuff like that. And then I'm also looking for energy service companies because they're a little bit different dynamic than the commodity itself. So you can have some commodities that are still down. You have some commodities that are breaking out. Some have already taken off. I would not say that natural gas in Europe is cheap. That's very expensive. Same with coal. Coal is becoming more expensive. It's going from an undervalued state to more of an overvalued state. Now, I don't know where the ultimate top is for this stuff, guys. I mean, this is going up quite dramatically, and I wouldn't have guessed that the moves. I would guess that the moves were going to be big, but I didn't guess that they would move this fast, especially coal and natural gas, and they've gone quite vertical very quickly. So what I'm doing is I'm looking for things that are down. So natural gas is very high and very expensive in Asia. It's very expensive in Europe. I think that's probably going to transfer to America. So all of these pricings, what I'm trying to do is when I was looking, I'll give you an example. I used to be a big coal. Last bull market, I was an investor in coal, and I was watching the entire sector. All of it fell very quickly. I can't remember the exact date. It was during the bull market though. They all fell, and I didn't know as much as I do now. It all fell, and there was a laggard, and it fell a lot. We're talking like 20% in a day. The ticker symbol was KFX. KFX created a fuel that you could put in the coal, and it would burn more efficiently, and it would always lag the companies, the coal companies. So they all fell. They blew out. It was down like 20% in one day. So I shorted KFX with a huge short, and it fell like 20% too, like a day or two after. Then it fell again, and then it fell again. I only got one day. I took my profits, whatever. I thought it was like a huge day for me, and it was, but I missed out on another like 20, 30, 40% down. It was like massive, move lower. But I was using the coal companies as the leaders and this KFX as the laggard. So what I was looking for is the correlation, but one just being lagged behind it. If natural gas is higher everywhere else in the world, and we're going to export our natural gas to those places, what do you think that's going to do to our natural gas prices? It's probably going to pull them up higher. So I'm looking for those opportunities. I'm looking for the laggards, and I think natural gas in America is lagging the prices of Europe and Asia. And I think that, I don't know where it's ultimately going to go, but I think it's going to go higher. You can see it in the charts. It looks really good. We have a breakout of a long-term resistance line. It's doing a back test, and then we're going to go higher. So some of these companies, like a Comstock Resources, CRK, that thing's massively lagging. That's a great thing, because I think that it's going to follow the price of natural gas much, much higher than where it is today. So that's something I look for. A lot of these energy service companies are putting in Wyckoff accumulation patterns at its bottom. So that is lagged. Gold, usually you get this first initial breakout, then it comes down and does like a big consolidation period. Those are lagging some of the other commodities. I think they're going to catch up and do very well. Platinum's still down low. Silver's still down low. I'm surprised that you can still buy physical metals where they're at. I think the physical metals is a great play on an energy crisis. Why? Because that's energy sunk into it to get those metals out of the ground. An existing house may be a great investment. Why? Because it has existing energy in it. Now, looking at like currency things, and I'm going to divert a little bit. Currencies are all backed by energy, and that it's a future repayment. So a currency or a note is debt, and debt is a future repayment. It's a payment in the future. If you have payments in the future and they're all backed by basically energy, it's not backed by like a physical item. It's backed by a future payment of something, and a future payment, a final payment, is not holding onto that dollar. It's holding or getting a tangible thing. It's getting a natural resource, getting a service, getting something. I mean, you could buy intangible things, but it's usually a payment of something, either a natural resource or a product made from natural resources. Now, if all these currencies are designed to blow up, right? They got to keep blowing up and expanding. It means that your energy system has to continually grow and expand. If your energy system doesn't grow and expand, your currency is going to have problems. Your currencies and all these currencies will have problems because debts will start to implode. It will be a deflationary cycle at some point because what you're saying is that the debts cannot be repaid and the future growth cannot be materialized if you are short energy. Now, I know I always dance on the line of these are all theoretical type thought, things. It's not, I'm not telling you guys that this is what's going to happen. What I'm doing is I'm dancing on the theoretical line of if we get into a major shortage of energy, what does that look like? Could it destroy currencies? Yeah, it could. Because you're going to get, you'll get into a weird scenario where your products become so scarce and at the same time the debt cannot be repaid. You get this weird dynamic. So this weird dynamic here of things not being paid, which is deflationary, but at the same time, the products are going away too, because you can't manufacture something if you have shortages in it, or if you don't have the energy to make it. Now I'm going off the deep end. Maybe we have solutions. Maybe we can figure this stuff out. I'm not exactly sure. But I'm just looking at these things going vertical. The prices of coal, the price of natural gas, and I'm starting to see it show up in oil now, and I'm starting to see it in U.S. natural gas looking like it wants to rocket. We're seeing uranium break out to the upside, and I'm just trying to piece things together. And uranium is still down in this commodity bull market. So I'm looking at sectors that are down in relationship to other assets. The ratios haven't broken out. Oil's mid-stride in its move. It's broken out of its lower resistance line. I can probably pick it up here real quick, and I'll just show you real quick what that looks like. And uranium hasn't broken out yet. So I'm looking for things that are still down and still cheap, and where the charts look really good. And oil is it's really starting to take off. It's got companies there are some companies that are still down that look really good. Would I be adding a whole bunch into oil? I mean, yeah, I would. There's still very good, I think, big patterns that could potentially break out. So what I'm doing is I'm going to the ratios here. That's where I seek value. Here we go. So here's the gold to oil ratio. Get me out of the way. You can see this clear break to the downside. We're at 15. 15 is basically the long-term average of the ratio. We've broken this downtrend. The bottom, or I should say, the bottom support line. Let me get it off log. Here's the bottom line here, and you can see it's a clear break to the downside. We are going to run in oil, is my guess, and we're going to compress to a very big state. Now, this is an undervalued state. This is an anomaly in history where oil went to over 100 barrels of oil to 1 ounce of gold. Now, this is going to be a run, and it's going to run at the same time that gold goes up. So this is going to compress and go up faster than gold itself. But it's still very, it's still a normal ratio. It's not cheap. It's not expensive. It's just normal. Uranium is still incredibly cheap. Now, here's another thing. If energy prices are doing what they're doing, and we're going to see potentially shortages of energy, this is basically a prelude to shortage of energy. What does that future look like? What kind of I'm going to throw out a scenario, and I don't know if this is going to work. I'm stuck in the thought process, like the theoretical type. If this happens and the tertiary effects. So here's something that could potentially happen. If energy gets short enough, and I've read many articles on the market balances on a lot of these minerals. So copper, aluminum, nickel, cobalt, lithium, and go on and on and on. The flow rates of these have astronomically high flow rates in the future of where we are today. We're talking 2 times, 3 times, 5 times, 10 times, 30 times the production growth, which means that all of these sectors need massive amount of investment in order to get them out of the ground. What I'm kind of thinking is they're probably not going to be able to ramp them that much, especially where the ore grades are with copper. So if you're going to see shortages of minerals where we're going to have to ration based off price, based off whatever, those minerals aren't there. So you're not going to be able to ramp up a renewable world if the minerals aren't there. So if in a world like that, the existing infrastructure becomes infinitely valuable. And what do we have for existing infrastructure if we hit an energy crisis? Well, you're going to be running your coal over time. You're going to be running natural gas, and we're seeing the prices go vertical of those. People, I think, or countries will turn back on their nuclear power plants. That's the next one. The infrastructure is already there. The minerals already sunk into these things, and maybe they just have to tweak or renew or upgrade or rebuild some of these things to get them back up and running. So, in my opinion, this is what could potentially happen. And this all stemmed from the question that you had on what's down still. And uranium is still down, definitely. So if they have to start these things back up because the minerals already sunk in, the energy sunk in, it's already there, we're going to see everyone run at uranium. And if they're going to restart everything, then and that these things were just shut down, they don't have the fuel to run it. We see large deficits in the future. And if you were to price the dollars per energy unit, uranium is like the cheapest there is. You are paying the least amount for a dollar per energy basis of uranium. So that could be, in my opinion, if you start pricing things in dollars per energy unit, we are so underpriced in uranium, it's ridiculous. And I don't know if we're going to reach that potential. I don't know if we're going to start pricing things in dollars per kilowatt hour. I'm not exactly sure, but I can tell you this. With the energy increases that we're seeing in electricity prices in some of these European countries, and even the United States, like California, we could go many multiples higher, many multiples of the price of uranium and not affect the end user. Each penny of kilowatt hour increase is an increase of $200 per pound in uranium. If we run into shortages that we cannot build or expand as quickly as we can, and we get into kind of an energy crunch, and they say, okay, let's flip back on all these uranium, the nuclear power plants that use uranium. And the pricing of electricity has gone up 5-fold, 10-fold, 20-fold. And let's just say it's 5-fold. Let's just say, let's say we go up 10 cents. 10 cents times 200 is $2,000 a pound. We could go to $2,000 a pound of uranium and still be completely underpriced and under everything else in the renewable sector or in the current pricing scheme of how much electricity's gone up. If you start pricing things to the end user, and if that's all we have and everyone fights after it, well, there's your squeeze, because you can't bring these mines online very quickly. So I've got my kids, they're all running down here right now. But think of things kind of like if we were to have a little bit more of an energy constrained world, some of the aluminum deficits in the future in 2024. Some of the people are saying that it's an unsolvable deficit, that we're going to hit shortages of aluminum, that we're going to see a super spike. That's in 2024. I think this is going to correlate with almost everything. We're going to start seeing spikes in a whole bunch of different things because we are literally short the material. So I'm going to end it there, guys. Give me a thumbs up if you guys like the content. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.